Hello everyone. Today we will talk about pricing and credit strategies. Pricing, a creative blend of art and science. Pricing is one of the most critical decisions for entrepreneurs, playing a fundamental role in a business's profitability and sustainability. Studies conducted by the consulting firm Accenture reveal that a mere 1% increase in price can yield an 11% boost in profits, a substantial gain that starkly contrasts with the effects of a comparable 1% reduction in costs. This highlights the power of pricing as a lever to rapidly enhance profitability and underscores the potential risks it poses if handled improperly. Improper pricing strategies can lead to significant challenges for businesses. Setting prices too high can alienate potential customers, resulting in diminished sales, while pricing products too low, a common pitfall for first-time entrepreneurs, can undermine profit margins, create a perception of inferior quality, and jeopardize long-term viability. Many entrepreneurs misjudge their pricing, mistakenly believing they can cover costs when, in fact, they are not charging enough to maintain profitability. Consumer expectations have shifted significantly in the wake of the Great Recession, leading to increased price sensitivity. Many consumers now perceive value through pricing, which means they are more inclined to seek discounts and compare prices using technology. Statistics reveal that a large percentage of shoppers actively look for sales or the lowest advertised prices, demonstrating a new age of price transparency. This environment compels entrepreneurs to be more vigilant and strategic in their pricing approaches. The relationship between price and perceived value can often be puzzling. Higher prices can enhance a product's appeal, leading consumers to associate higher costs with greater quality. For instance, the Panama Hat Company sells handcrafted hats ranging from $650 to $25,000, with pricing reflecting the meticulous craftsmanship involved. Similarly, Ulysse Nardin's luxury smartphones illustrate that despite lower-priced alternatives, the allure of exclusivity can draw significant consumer interest, resulting in thousands of orders. Custom jeans from 3 multiplied by 1, ranging from $295 to $750, further exemplify how personalized offerings can command higher prices based on consumer perception of value. Pricing is not merely a mathematical decision. It is a psychological challenge that requires entrepreneurs to balance various factors. The price floor, the minimum required to cover production costs, must be carefully calculated, while the price ceiling reflects the maximum consumers are willing to pay based on perceived value and competition. This range defines an acceptable pricing strategy, which should not only emphasize competitiveness, but also resonate with consumer expectations. Many entrepreneurs fall into the trap of mimicking competitors' pricing, but this approach can be perilous. It's essential to base pricing on accurate assessments of production costs and a nuanced understanding of customer preferences and behaviors. Effective pricing strategies are often developed through thorough market research and direct engagement with customers to gather feedback. Ultimately, the goal is to position prices strategically within the acceptable range, guiding customers' perception of the brand, whether it seeks to portray discount, value-oriented, or luxury images. For instance, entrepreneur Brian Yonechko leveraged customer surveys to identify an ideal price point for his product, ensuring it aligned with market expectations and consumer willingness to pay. In conclusion, effective pricing is a blend of art and science, necessitating continuous assessment and adaptation to align with customer perceptions and evolving market conditions. Strategies for managing rising costs. Entrepreneurs often find themselves squeezed by escalating operating and raw material costs, yet many hesitate to raise prices due to the fear of losing customers. To navigate this challenging landscape, several strategies can be employed to manage costs effectively while maintaining customer loyalty. One effective approach is to communicate transparently with customers. For example, Danny O'Neill, the owner of the roastery, faced significant increases in coffee prices, but adeptly informed his customers about the situation through detailed letters and news articles. This transparency not only established credibility, but also allowed him to pass on the cost increases without losing any clients. Instead of directly raising prices, businesses might consider implementing a surcharge. This tactic is useful when the increase in costs is temporary due to specific events, such as natural disasters. Ricky Eisen, who runs Between the Bread, added a 5% fuel surcharge to offset skyrocketing fuel costs, allowing her to manage expenses without permanently altering prices. Another subtle strategy is to eliminate discounts, coupons, and freebies. Over time, these promotional measures can significantly erode profit margins. By cutting back on these offers, companies can subtly increase their effective pricing while maintaining the appearance of consistency to customers. Offering products in smaller sizes or quantities can also help manage costs. Restaurants have successfully introduced small plates to keep menu prices stable in the face of rising food costs. Similarly, quick service outlets have tapped into the trend of mini burgers marketed as fun food, which aligns with consumer desires while controlling overall expenses. Improving internal operational efficiency is another effective means of coping with rising costs. For example, Genmore florists reduced their delivery frequency to cut transportation expenses. While this approach may not completely offset higher raw material costs, it can mitigate their impact on the overall business. In some cases, it may be strategically advantageous to absorb short-term cost increases. Retaining valuable long-term customers can outweigh the benefits of immediate profit adjustments. Many businesses that choose to absorb costs often discover alternative efficiencies that help maintain financial stability. Emphasizing the value of products or services is crucial. Small business consultant Elizabeth Gordon reminds us that if customers recognize the benefits being offered, they may be more accommodating toward minor price increases. Reinforcing the perceived value can lessen potential backlash from customers when prices rise. Incremental and consistent price adjustments can also reduce the likelihood of customer resistance. For instance, Buffalo Wild Wings gradually raised the price of its chicken wings in small increments, avoiding significant sticker shock among consumers. This method allows businesses to adjust in a way that feels natural to customers. When possible, businesses should shift to less expensive raw materials. During price surges for seafood and beef, many restaurants introduced more chicken dishes to keep menus affordable. Similarly, jeweler John Christian adapted by creating more designs in silver and less expensive materials, allowing them to remain price competitive while diversifying their offerings. If prices must be maintained, modifying existing products or services can lower costs. Quick service restaurants often find ways to make value menu items more cost-effective without undermining quality. However, it's crucial to avoid over-modifying products to prevent damage to brand reputation. Lastly, entrepreneurs should anticipate rising material costs and lock in prices early. Keeping an eye on raw material price trends helps businesses plan and negotiate long-term contracts. potentially safeguarding against future inflation. By taking proactive measures, companies can navigate cost increases more effectively and maintain their competitive edge. 3 powerful pricing forces: image, competition, and value. Price conveys image. A company's pricing policy serves as a significant tool for establishing its brand identity and crafting a desired image among target customers. Businesses can use pricing strategies to either project an image of exclusivity or promote affordability, thereby attracting specific market segments. For instance, brands that adopt a high-price strategy often convey quality and prestige, appealing to consumers who value uniqueness and status. Products like oyster bamboo rods exemplify this principle, where their perceived value stems not only from technical performance, but also from their scarcity and the wow factor they represent to buyers. Many small enterprises fall into the trap of underpricing their offerings, mistakenly believing that lower prices are their only competitive advantage. Research by McKinsey & Company indicates that 80 to 90% of pricing errors involve setting prices too low. This oversight can lead small businesses to overlook the additional value, service, and customer attention they provide, factors that many customers are willing to pay a premium for. Interestingly, a global study by Accenture reveals that a significant percentage of consumers, 67%, refuse to compromise on quality for a lower price, emphasizing that price should not be the sole focus of the marketing mix. Competition and prices. When determining appropriate prices, monitoring competitors' pricing is critical, but it's only one aspect of the pricing equation. Entrepreneurs should consider their competitors' prices without merely matching or undercutting them. A business that offers superior quality, service, or value can justify higher prices if customers recognize and appreciate these differentiators. For instance, if a local gas station prices fuel slightly higher than a competitor, it risks losing customers unless it can offer something unique, like better service or convenience. Understanding the nature of competing products is essential. Entrepreneurs should identify direct substitutes and ensure prices remain competitive relative to those alternatives. For example, a sandwich shop competes not just with other sandwich establishments, but also with any fast food outlet. Facing competitors with lower cost structures, small businesses should emphasize non-price competition, such as personalized service or unique offerings, rather than engaging in a potentially damaging price war. Price wars can devastate profit margins and force businesses out of the market. The tablet industry illustrates this reality. When Amazon introduced its lower-priced Kindle Fire to compete with Apple's iPad, it initiated a series of price cuts across the board. Although Apple maintained its premium pricing strategy, other competitors had to adapt, highlighting the complexities and volatility that accompany direct price competition. Focus on value. Ultimately, the right price hinges on the value it provides to customers. Value comprises both objective and perceived dimensions. The objective value is what customers might pay if they fully understood the benefits offered by a product or service. However, customers often only perceive value based on their experiences and beliefs. Business owner and consultant Jim Barnes notes that consumers evaluate total value beyond just price, seeking the overall best offer. Companies that successfully enhance customer perception through streamlined purchases, excellent service, or unexpected extras often avoid the need for aggressive price cuts. However, constant reliance on discounts can undermine the perceived value and damage brand integrity. customers may become conditioned to expect sales, leading to fluctuating demand. To counteract price sensitivities while maintaining a strong brand, companies can employ strategies such as offering time-limited promotions or launching a fighter brand, a no-frills competitor designed to appeal to budget-conscious customers without devaluing the flagship brand. Intel's introduction of the seller-on-chip exemplifies this tactic, allowing the company to fend off lower-priced competitors while preserving its premium image. So, understanding the interrelated forces of image, competition, and value is crucial for entrepreneurs setting their pricing strategies. Maintaining a constant focus on the unique value they offer while strategically positioning prices relative to competitors can help businesses thrive in a challenging marketplace. By effectively communicating this value and adapting their strategies accordingly, companies can not only survive but excel, even in competitive landscapes. Pricing strategies and tactics. Pricing strategies and tactics offer a diverse range of options for entrepreneurs, allowing for creativity and adaptability in their approaches. It is crucial for these pricing strategies to align with a company's overall marketing and business objectives, as pricing plays a fundamental role in a firm's strategy. New product pricing, penetration, skimming, or sliding. Setting the price for a new product often generates apprehension among entrepreneurs, particularly because there may be no historical data or precedents to guide their decisions. Many new businesses instinctively look to competitors for pricing cues, typically opting to set their prices slightly lower than the competition. However, this can lead to significant challenges. If a new product is priced too high, it risks insufficient sales volume and potential failure in the market. Conversely, pricing it too low can have its own pitfalls, including the inability to cover costs. Establishing a low price can be particularly hazardous, as it not only forfeits potential revenue, but also diminishes the product's perceived value among customers. Norm Brodsky, a serial entrepreneur, cautions against building a business around the lowest price, noting that such a strategy invites intense competition, forcing continued price reductions that create an unsustainable commodity mindset. To avoid the trap of underpricing, entrepreneurs should consider the total value that their offerings provide, including intangibles like superior service, convenience, and speed. By setting prices that accurately reflect this value, businesses can avoid undermining their products and build a stronger market presence. Common pricing tactics. Penetration pricing. This strategy involves setting a low initial price for a new product to quickly attract customers and gain market share. It is particularly effective in competitive markets where establishing a customer base quickly is essential. Price skimming. This tactic sets a high introductory price to maximize profits from early adopters who are willing to pay more for a new or unique product. As competitors enter the market, the price may gradually decrease. Sliding scale pricing. This approach allows prices to change based on different conditions, such as customer demand or purchase volume, enabling flexibility in how prices are perceived and accepted by the market. When introducing a new product, entrepreneurs must satisfy three primary objectives: securing product acceptance, maintaining market share, and ensuring profitability. First, the price must be acceptable to potential customers, which varies significantly based on the product type. Revolutionary products, which transform an industry, can command prices near the ceiling, but marketers must also educate customers about their benefits. Evolutionary products enhance existing offerings and can only justify premium pricing if they are sufficiently differentiated from competitors. Meanwhile, Me Too products, designed to compete in an already saturated market without offering uniqueness, have the least pricing flexibility. Success in this category largely depends on effective cost management and precise market targeting. Secondly, as successful products attract competitors, small companies must continuously reassess their pricing strategies to maintain or expand their market share. This requires an adaptable approach that aligns pricing with marketing tactics. Lastly, generating profits is a critical concern. Prices must exceed costs for long-term viability. While setting an introductory price too low can seem appealing, it is often riskier than setting it too high. Entrepreneurs frequently underestimate the dangers of underpricing, which can lead to unsustainable business practices. To effectively establish prices for new products, entrepreneurs have several strategies at their disposal. One common approach is penetration pricing, which involves introducing a product at a low price to quickly capture market share. This strategy helps to build sales volume and deter competition, particularly in markets where products are not significantly differentiated. However, penetration pricing can attract customers who lack brand loyalty, and achieving profitability may take time. Another strategy is price skimming, where companies set a high initial price to recover development costs and target consumers willing to pay a premium. This approach allows for quick returns and reinforces a high-quality image, but it requires strong differentiation from competitors to justify the elevated price. Conversely, life cycle pricing starts products at a high price that gradually decreases, reflecting the cost reductions that accompany economies of scale and technological advancements. This method can effectively support initial cost recovery while preparing for increased competition over time. For established products, entrepreneurs can employ a variety of pricing techniques. Odd pricing, for example, uses prices that end in odd numbers to create an illusion of lower cost, although its effectiveness can vary. Price lining simplifies decision-making by offering products in multiple price tiers, appealing to different market segments. Freemium pricing targets users with free basic offerings while charging for premium features, ideal for software and services. Dynamic pricing adjusts prices based on demand and competitive factors, especially in online retail. Leader pricing involves lowering the price of popular items to attract more customers, thereby increasing overall sales through complementary purchases. Geographic pricing allows businesses to set different rates based on location to account for shipping costs. Discounts can help clear slow-moving inventory, but businesses must be cautious not to damage their brand image by relying too heavily on markdowns. Bundling products into value-added packages is another effective strategy, as it can enhance consumer appeal without significantly undermining profit margins. Optional product pricing involves selling a basic product while charging more for accessories, a well-known tactic in industries like automotive sales. Captive product pricing, exemplified by razors and blades, focuses on making the main product inexpensive while generating higher margins from its accessories. Lastly, pricing decisions must be dynamic and responsive to changes in the market. Entrepreneurs should regularly evaluate their pricing strategies in relation to their overall marketing objectives and costs. By understanding the various pricing strategies and techniques available, entrepreneurs can establish effective pricing plans that align with their business goals while adapting to the changing landscape of competitive pressures and consumer preferences. Pricing techniques for manufacturers. For manufacturers, the pricing decision hinges on the availability of accurate and timely accounting records. Among the various approaches, cost-plus pricing is the most prevalent method. This technique involves setting a price that covers direct materials, direct labor, factory overhead, selling and administrative costs, along with a predetermined profit margin. The primary advantage of cost-plus pricing lies in its simplicity. With reliable cost data, calculating the final selling price becomes straightforward. Additionally, since this method ensures that a profit margin is added to the total costs, manufacturers can typically achieve their desired profit levels. However, cost-plus pricing has significant drawbacks. One major limitation is that it does not inherently encourage manufacturers to use their resources efficiently. Moreover, given the broad variability of cost structures across different manufacturers, this pricing approach often does not adequately account for competitive dynamics in the market. Pricing expert Rafi Mohammed highlights that the price consumers are willing to pay is often unrelated to manufacturing costs, suggesting that a more effective strategy would center on capturing the product's value rather than merely applying a markup to costs. Despite these limitations, cost-plus pricing remains a common strategy in various industries, such as construction and printing. Direct costing and pricing. A robust cost accounting system is essential for effective pricing policies in manufacturing. Traditional product costing is known as absorption costing, which allocates all manufacturing and overhead costs to the final product's cost. This method includes direct materials, direct labor, and both fixed and variable factory overhead in the cost of each unit manufactured. While full absorption financial statements are utilized in annual reports and tax filings, they are less helpful for making pricing decisions or assessing the impact of price adjustments. In contrast, variable costing, or direct costing, focuses only on the costs that fluctuate directly with production levels. This approach includes direct materials, direct labor, and variable factory overhead while excluding fixed costs like rent and depreciation, which are treated as period expenses. By using variable costing, manufacturers can establish a clearer relationship among price, sales volume, and costs. The aim is to determine the optimal combination of selling price and sales volume that exceeds the variable production costs, thereby contributing to fixed costs and generating profit. The starting point for determining product prices should be a direct cost income statement, which presents a clearer breakdown of expenses as fixed and variable. This distinction helps in understanding how variable costs relate to total revenue. When variable costs are deducted from total revenues, the resulting figure is known as the contribution margin, which indicates how much revenue is available to cover fixed expenses and yield a profit. The contribution margin can be expressed as a percentage of total revenue, referred to as the contribution percentage. This is a crucial element in pricing decisions made through the direct costing method. Understanding the contribution percentage is vital for manufacturers, as it reveals what portion of total revenue remains after accounting for variable costs. For instance, if a manufacturer has a contribution percentage of 36.5%, this indicates that 63.5% of total revenues are absorbed by variable costs. By calculating the contribution margin and understanding its implications, manufacturers can set pricing strategies that adequately cover both fixed and variable costs, ultimately leading to profitability. This process is essential for effective pricing in competitive manufacturing environments, allowing businesses to remain viable and profitable. The impact of credit on pricing. Linking a company's pricing strategy with its credit policy is vital in today's business environment. as consumers increasingly prefer the convenience of buying on credit. Small businesses typically have three options for offering credit: credit cards, installment credit, and trade credit. Credit cards. The shift towards card payments is evident. Since 1992, cash transactions have dropped significantly, with consumers now favoring credit and debit cards. Over 2 billion credit cards worldwide account for nearly $6.1 trillion in annual purchases. Businesses that do not accept these cards risk losing sales. While credit card transactions can increase customer spending, they also incur costs, such as processing fees, 1.5% to 3% of each transaction, plus standard per transaction fees. These costs must be reflected in pricing, particularly impacting small businesses that often pay higher fees. Companies like Square are innovating in this space by providing mobile credit card processing solutions. E-commerce challenges. Online merchants rely heavily on credit cards but face challenges such as security concerns and fraud, losing approximately $3.4 billion annually to fraudulent transactions. To mitigate fraud, businesses can use verification systems and monitor orders closely, enhancing customer trust. Debit cards. With over 4.5 billion debit cards globally, these options provide an alternative payment method that is often cheaper in terms of transaction fees compared to credit cards, contributing to improved cash flow and reduced bad check losses. Installment credit. For big-ticket items, installment credit allows customers to make purchases over time, often starting with a down payment. This financing option can generate additional revenue for businesses, particularly in sectors like auto sales. Trade credit. Small businesses selling to other companies often offer trade credit through charge accounts, invoicing monthly. While trade credit can cultivate customer loyalty, it carries risks that require careful management to ensure timely payments.
Thank you for watching. If you liked this video, please like and subscribe to channel.